Hi everyone. In part 4 of this series, we are going to talk about how to build a proper dividend portfolio that pays you for your lifetime, that saves you from a daily job so that you can get passive income on a regular monthly basis, which will protect you in the long term and it will help you to retire early. So, why do we have to focus on dividend investing? There are other types of investing like growth investing, there is value investing, there is cyclical play. So, why dividend investing? So, dividend investing is a type of investing strategy where you can keep creating income over a period of time, even without you putting additional efforts. So, in times of market meltdown, like that is happening now, so Sensex has come down from 26,400 to 21,000 now. It can go down to even 18,000. But any company with strong dividends, anyone with a dividend portfolio can have proper stability during these downturns. You can build long-term wealth and sit at your home happily. So if you have invested 10 lakh in a solid dividend stock with a 5% dividend yield, you can earn 50,000 every year. With if you keep reinvesting these dividends back, you'll keep getting more money through the power of compounding. So we spoke about this in our previous video. So key criteria has to be an ideal dividend yield between 3 to 6%, a decent growth rate, a payout ratio below 60% is ideal, and any company with strong business model, stable revenues, consistent profit growth, low debt, and high ROE are good when it comes to considering them as dividend stocks. So, how to balance your dividend portfolio? So, we can split it into three types. One is to have a set of core stocks. 60% of your portfolio can be in core stocks that are stable and low risk companies like HCL, TCS, Asian Paints. So these are large caps that are solid and stable. So if you look at TCS, so they have been growing from 62,000 crore to 2.5 lakh crore. So for 4x and their revenues are huge. Their profits are huge, 14,000 crore. So the dividends are solid. The company itself is extremely stable. You don't have to worry too much. Same is the case with Asian Paints. Though Asian Paints is struggling recently, in the last couple of quarters, it's still a strong company from 10,000 crore to 35,000 crore. The regular dividend payout of 40 to 60%. So Asian Paints is a solid company when it comes to adding it to your core stock portfolio of dividend investing. So the second type is growth stocks with some capacity to provide good dividends. So there are some mid-cap companies like Divis Labs, Pharma. So if you look at Divis Labs, that's a good market cap. So if you look at it, they have been consistently paying dividends for 10 plus years. Good numbers. So same is the case with a company like Bata. Bata only has 15,000 crore market cap. So they pay dividend every year except this 1 year. So every year they've been paying dividends. Same is the case with Bata competitor called Relaxo. They've also been paying decent dividends. They increase their dividends after a certain number of years. So there are multiple reasons here. So you can build a portfolio with a core set of stocks that are large blue chip companies that are part of Nifty 50, and then second set is growth stocks with good dividend yield, and then high yield stocks with some risks like Coal India. So let's look at Coal India. So Coal India has a 7% dividend yield, but this is solid. So this is far more than what an FD can give you. And if you look at this company's balance sheet, they have cash, cash and cash equivalents. 32,000 crore cash is available with them, which is a huge number. So you don't have to worry too much about revenue growth, profit growth, because they already have huge amount of cash available, so they keep paying dividends here. So you can consider such company with high yield as part of your portfolio as 10%. The portfolio spread across high yield stocks, growth stocks, and stable stocks balances your portfolio risk and returns. The other important thing is dividend reinvestment, which will basically multiply your wealth several times. So instead of taking dividends every year, if you reinvest your dividends to buy more shares, you'll keep accumulating more shares. Your shareholding will grow, your dividends will grow, the cycle will repeat. So if you look at Asian Paints, say 1 lakh rupee invested in Asian Paints in 2000 would have grown to 1.5 crore today if you are reinvesting that dividend. Let's look at Asian Paints now. So new data is available from here. So here to here it is 1.5 crore with dividends. Without dividends, this would have been a lot less. So pick 8 to 12 strong dividend stocks and start investing in them. So you can diversify across different industries like banking, FMCG, IT, utilities. Primarily, all of them are safe and stable companies. Look for strong dividend growth, payout ratio. Always reinvest dividends to compound your wealth. So hold for long term, 5, 10, 15 years. So disciplined investing strategy can give you lifelong passive income. So thank you. That's it for today. Have a great day.